Hello and welcome to another episode of Be the Boss of Your Money. This is a live stream. It's all about personal finance. I do this every Monday through Thursday at 4:30, and I really appreciate you taking the time to join me. I know your time is valuable, and it means a lot to me that you chose to spend some of it with me. We're going to talk about personal finance, investing, stock market, borrowing. We talk about everything here, personal finance. Okay, so what's the big deal today? The big deal today is the rebound. Stock market rebounded pretty darn big. Basically, what you saw happen on Friday to the downside was completely reversed today. But now the hard part starts. Does this have legs? Is this a rally that works for a longer period of time, or is this just a technical balance that undid some of the damage last week to the markets? And it's a bounce, and now the real work begins. So these are some of the things that we're going to talk about. We're going to talk about the Fed update. A couple things have changed. My point of view is that the Fed hasn't really changed all that much. And, so the economy's stronger. Maybe the Fed moves up its timeline a little bit sooner for trimming its bond buying, tapering. Maybe raises interest rates a little bit sooner. Folks, when we talk about the Fed raising interest rates, we're not talking about the Fed jacking up interest rates, short-term rates like 4 or 5%. We're talking maybe a couple of rate hikes. And at this point, there are a lot of very smart people on the street who think the Fed's in a box and it can't raise interest rates. So we need to talk about these things because this concerns your money. Let's roll a quick intro. We're going to get into it right now. Thank you. Here we go. Thank you for joining me. My name is Mitch Goldberg. If you're just joining us now, this is my live stream. It's called Be the Boss of Your Money. It's the place that you can go to learn about personal finance, investing, credit, borrowing, all those important things about personal finance. Today, we're talking about the market, the Fed. So many things are swirling around. So we're going to do a quick review with perspective. I'm going to put this all together for you. You're going to walk away with a sense of, what's going on because we're going to talk about it. Now, we can't draw hard conclusions from every move in the market. I know that the talking heads, analysts, they're expected to give you an explanation for what happened. Oh, the market's up to, well, it's up because this, and that, and it's down. Well, it's down because this, and that. And everybody's telling you it's up, why the market's up today are just the exact opposite reasons for why it was down last week. But sometimes we don't know why the market is up or down until some time goes by. And then we look back and we say, aha, that was the clue. Those were the signs. Yeah, I know. If I could tell you what those are exactly, I would tell you. But let's put some things in perspective. How many times have you heard me say, don't just bet on the reflation trade, reopening stocks, and don't just bet on the work from home, stay at home tech stocks. You have to have, you don't have to do anything. I think it's important to have both. It's called diversification. And diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market, which is what we saw last week. But it keeps you in the game longer. It keeps you investing longer. If you're just seeing your portfolio gyrate up and down, and you were just, let's say, in the reopening stocks, yeah, you would have made a ton of money from the bottom of the pandemic bear market, right, in March of 2020 till a few months ago. But then you would have lost a lot of that money, a lot. And you would have been better off diversifying. And maybe if you just held value, well, great, you'd be doing better now. But over the last, 10 years, growth has handily outperformed value. It's hard to know exactly when growth outperforms, when value outperforms. I think it's important to have both. And sometimes Sometimes a good growth stock will go down, still be a good company. When I say goes down, the stock goes down, the company could still be doing fine. And then it becomes a value stock. And sometimes a value stock, value company gets its mojo back and they start hitting it out of the ballpark with earnings and revenue growth. And guess what? That value stock has now become a growth stock. And this is always happening, this back and forth. It never stops. It's just the constant evolution of markets. And right now, I know it seems like we're seeing a revolution, where meme stocks, crypto, a lot of things are changing. But we've had internet stocks in the past. We've had speculative fever in the past. This isn't the first time we've seen it. What's different now than, let's say, 21 years ago when we had right before the tech wreck is that today we just have the speed of travel of information. Information travels so quickly to everybody. It used to be you had to wait for the evening news or watch an evening show on CNBC to catch up. And you're talking about catching up with very broad strokes over maybe a half-hour show. Today, we've got a 24-hour news cycle. Yes, I know you know that. But the financial information combined with social media, it's really incredible. This is how Wall Street Bets works. It's social media that disseminates quick hits of rapid fire information that people trade on. But if they see a little bit of momentum start working in a particular, they meaning people who are trading crypto or meme stocks, when there's a little bit of movement, that information must be right. Everybody jumps on it, and then the information stops or changes. Everybody jumps off. And it's just creating a lot of volatility. And it's not just crypto and Bitcoin. It's the stock market overall. It's crypto and Bitcoin are just the newest and latest examples of how quickly things can happen. So the Dow is up 586 points. I'm going to show you the screen. Okay, let me put the screen on. Oh, come on. I really hate when that happens, but I want you to know I've ordered a new computer that's going to have a lot more capability. The fact is, the computer I'm on now, when I got this computer, I never, ever in a million years expected that I would be live streaming. I just never expected that. But now that I'm live streaming, I love it. But I've been slowly upgrading the gear. I've got the mic. All right. I've got the mixer, the XLR mic that goes into the mixer. I've got all the knobs and buttons and everything dialed in exactly the way I want it. That makes me really happy with how my voice comes out. This stuff doesn't change your voice, but it makes your voice sound as good as it can look, as good as it can sound. Okay. This is my switcher. And I've got my iPad, so I could put sound effects. Let's hear it for the market today. Okay, that's the kind of thing that I refer to. Okay, so these are the kinds of things that I'm doing, and slowly but surely, building up my repertoire of technology. And I've got camera 3, so I'm showing you this stuff over here. And I could pop myself up here. So you see me in the corner, camera 1, and I'm going to go to camera 2. See, so I've got camera 2. All right, but enough of that. I love this stuff. So let's see if we can still get there. No, okay. So what we're going to do is we're going to do a quick share screen because this is going to work out just fine. Don't you worry. Mitch finds a way. Get creative. Boom. Okay, you see that? You see that? You're going to see it in a second. All right. Hopefully you could see that on your smartphone, but it gives you a headache. It's so small. But the Dow is up 586, NASDAQ up 111. NASDAQ's at 14,000. I mean, that used to be like 50 points, and the NASDAQ not that long ago was a big day. Now, 100 points it's not even 1%. 140 points is 1%. S&P 500 up 1.5%, almost 1.5%. Gold up a little bit. Oil continues to move up. You know, a lot of people think that when you see a slowdown or worries about a slowdown, people automatically assume that all prices go down. If you recall, after Lehman Brothers blew up in 2008, the US economy, the global economy, went into a very deep recession. That's what we call it, the Great Recession. It didn't become a depression because of government intervention and Federal Reserve intervention. But oil still managed to go to $147 per barrel. So if oil doubled right now, it still wouldn't be as high as what we saw in 2008. The VIX comes in. It was in the thumbnail picture. Stocks up, VIX down. So the VIX is down 13.5%, down about 3 points, back under 20. And I just want to show you this, the Russell 2000 over here. Okay. The Russell 2000 up about 50 points. That's the standout winner of the major averages, up over 2%. The Russell 2000 is a gauge. Okay. It's, let me stop sharing the screen now. All right. The Russell 2000 is a gauge of small cap stocks. And small cap stocks are important to look at generally because they are, I think, a good tell for the U.S. economy. Not necessarily like how quantitative easing helps the stock market with large cap stocks, but with small cap stocks, they're more sensitive to the economy. Their revenues are more dependent on the domestic economy. Okay. They're smaller businesses, so they don't always get to just float more stocks or issue more bonds. A lot of times they have a harder time raising fresh capital. So they are a good view of the strength of the economy. Now, we see stocks go up and down all the time. And just because the stock market goes up 600 points or down 600 points from a day-to-day basis, that doesn't mean that the economy, got 1 or 2% better overnight. This is all based on people's very near-term reaction to changes in their perception of how good or bad the economy will do over the next few months, next 6 months, next 3 months. That's what you're seeing in the stock market. And ultimately, the economy will determine stock market performance. And the stock market, it'll follow the economy. And sometimes it trades up ahead of an improving economy, and sometimes the stock market will trade down ahead of a worsening or weakening economy. But we mustn't always confuse the two. When the stock market was rallying at the peak of the pandemic and the economic shutdown, a lot of people were thinking something's wrong here. The stock market should be going down. No, the stock market, as measured by the S&P 500, which is an index, right? And you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. The stock market tracks stocks, not the economy. And they're two different things. Okay, it just so happens to be that the S&P 500 has a very heavy tilt toward the kind of companies that benefit in the economic shutdown. Amazon, Facebook, Alphabet, Netflix, okay, Apple. You get my drift. That's really what the S&P 500 measured. It wasn't necessarily about whether more goods are moving on rails or trucks or consumers, we're traveling or buying goods or using services, that sort of thing. By the way, folks, if you have any questions for me about the economy, the market, hit me up. Whatever you think of, hit me up in the comments. I'd love to hear from you. I'd love to answer your questions. And if you're watching this in the replay, I'd like to welcome you as well. Certainly, words of encouragement and words of wisdom are always appreciated here on Be the Boss of Your Money. So I'm going to do another share screen. Let's get back into that. Share screen. Share screeny. The screeny. Did I just call it the screeny? Okay, let's take a look at crypto. Bitcoin is back down to 32,000. If you know if you could see that, but Bitcoin is in the 32,000 range, off over 7%. It was over 35,000 yesterday morning. But why is it going down? I think part of the appeal of crypto in general was that it was looked at as a replacement for gold and a hedge against inflation. But now that the Federal Reserve is taking inflation seriously, which they always were, but they're just actually now acting like it. Now that the Federal Reserve is letting all of us know that they are in the lookout for inflation and they're going to do something about it sooner than what we originally thought, it kind of makes you realize that inflation is not as much of a foregone conclusion as you thought. Now, yes, I hear what you're going to say, but we have massive and big time massive inflation now. A lot of this is considered transitory. When supply chains catch up to demand, the inflation will go away. Plus, demand is very strong because not only are you seeing your usual typical demand for goods and services, but you're also seeing pent-up demand mixed in with what would otherwise be normal, regular demand. So there's just a lot of demand and a messed up supply chain globally. That'll get rectified. I firmly believe that. And we might not go down to prices that we had in 2019. One of the former Federal Reserve governors, Michigan, said that, he talked about the possibility of permanent higher inflation. I don't like that. I'm not saying I don't like when somebody disagrees with me. I'm just saying that I don't like when somebody uses the word permanent in financial markets, because if there's anything that we've learned is nothing is permanent. There could be long-term cycles, but nothing is permanent. It's all cyclical. I think the only thing that is permanent reminds me of an expression. The only constant is change. But Bitcoin has come down. Why? Because if it's a hedge against hyperinflation or a lot of inflation, maybe hyperinflation's a little bit too much hyperbole. So let's just call it higher inflation. Well, the Federal Reserve has come out and said, no, we're not going to let that happen for too long. So the days of inflation might even be limited. And you have to ask yourself something. Why is it that I'm looking for the right screen here? Let's do another share screen. You've got to ask yourself a very important question. Share screen. Come on, here. You've got to ask yourself this. You see the 10-year Treasury at 1.49%? Why is this still under 1.5% if investors were truly worried about inflation? I've always considered the bond market to be the smarter of the two, of between the bond market and the stock market. I've always thought the bond market, I still think this, that the bond market is a little bit smarter and often a lot smarter than the reactionary stock market. Now, the 10-year Treasury was up to about 1.75, 1.77% a few months ago when investors were worried about inflation. And now the 10-year Treasury yield continues to go lower to 1.49%. The 5-year is 0.886. The yield curve, it widened slightly today. We'll talk about what that is in a second. But the yield curve widened slightly today. But the point is, when the economy and inflation, when you expect the economy to do well and to improve, and it is doing well and improving, but the yield curve should be getting wider. In other words, longer term rates should be rising. And it should be rising faster than short-term rates. In fact, if the Fed leaves short-term rates alone, then you get rising long-term rates, and that makes the yield curve wider. It's good for banks. If you recall, bank stocks got hit really hard last week. They went down a lot last week because the yield curve started to flatten a little bit. We can get into yield curve analysis all you want. And if the Fed wanted to change the yield curve, all it would have to do is just unload a couple of bucks from its $8 trillion balance sheet. And it could send long-term yields however high it wants to. The Fed is not into, they say they're not into controlling the yield curve. They're just more into adjusting interest rates to keep the money flowing in the economy. So these are the things that we're looking at. I don't like gigantic rallies in the market that follow gigantic that follow gigantic drops in the market. I don't like that, because typically what happens is you get a big rally and then they get repealed. Then they slowly fade away, and then the real work begins. I have never seen such a tug of war of the inflation crowd and the no inflation crowd like I have now. It's really remarkable how there are just so many investors who feel so strongly that inflation is going to go away. You need to own tech stocks because they're secular growers. You know, we're all moving more and more into putting more technology into our lives. So you want to own technology. And then there are so many people who say, no, you want to go into the value trade. You want to go into economically sensitive stocks because the economy is going to keep getting stronger and stronger and stronger. My contention a few weeks ago was that the cyclical trade, the reflation trade, has run just a little bit too far, and the technology sell-off has run a little bit too far, and it's probably time to rebalance the two. I hope you did that. I did. I did that on my end for my clients. And now we'll see which one works, which one doesn't. But if you're really worried about the stock market, you're really worried about inflation and the Fed making a policy mistake by raising rates too high, you can always just generally sell stocks and put that money into cash equivalents like money markets, savings accounts, CDs, or short-term bonds or ultra short-term bonds, and just leave it there. Nobody's putting a gun against your head and saying you have to invest. Now, if the money you have invested, you're not going to touch or need for 20 or 30 years, most of what I'm talking about doesn't really matter to you. What matters is that you understand how the market works and what's going on now, so that you could stick to your investments, so that you don't make knee-jerk changes, so that you can give your investments time to recover and grow and compound. That's really important, because we're not talking about timing the market. We're talking about time in the market. I hope this helps you out. I want to thank you so much. And I see one comment out there. Who is that? Keith Wilson. Hey, Mitch, thoughts on a double dip recession? It's a great question. You know, you ever notice when somebody says it's a great question, it means I have to stop and think about it for a second. All right, Keith. I like that picture. You know, I think that's cool. All right. My thoughts on a double dip recession. It would be really hard to envision a double dip recession unless we get certain kind of conditions, meaning a variant of COVID that completely overruns the vaccinations that we're using now, the RNA vaccinations. That would be one of them. Another thing would be if inflation truly gets out of hand. You know, you have to think about it like this. A lot of inflation is not a good thing. I can tell you a number of reasons why it's not, but basically your dollars become worth a lot less. And it happens quickly, where everything you buy costs more money, meaning you've got $10,000 a month, for example, to spend on living expenses. And now all of a sudden to keep up with your lifestyle, you've got to spend $12,000. It's an extra $24,000 a year just to stay even. Where does that money come from? Does that mean you stop contributing to your retirement plan or something? All right. So the fact that the Fed has indicated that they're going to keep an eye on inflation, and actually now that they want to act not only to tamp down inflation, I hardly call what they're doing tamping down inflation. They're just basically saying we are getting on board with the growth story in the United States, meaning we don't need all the stimulus anymore, but we are going to scale it back very, very slowly because we're doing our best to avoid a market disruption, like a stock market crash or a taper tantrum or something that lasts more than a week, like last week. Don't forget, 2 weeks ago, the stock market, all the major averages were hitting new highs. What a difference a week could make, right? I don't think okay. So anyway, the fact that the Fed is doing that actually, I think, makes the stock market, bull market we're in, more durable, not less durable. Okay, because blow-ups, or what's the word I'm looking for? Bubbles are not a good thing. Double dip recession. Thoughts on a double dip recession? I don't think we go into a double dip recession. It could happen, but the conditions that led to the last recession, the pandemic, I don't think we have that. I don't think we have a major problem with the banks, which was what led to the recession of 08, 09. As far as the tech wreck goes, 2000, that was a pretty mild recession. That was more of a stock market event than it was an economic event. And we had 9/11 in 2001, which added to the recession. But by 2002, we were already coming out of the recession. So I don't think we're going into a double dip recession. I don't think that's a possibility, in my opinion. I think more of, do we just get back to baseline growth of 2% inflation, 2% GDP, and just ever rising federal budget deficit? That's my, I don't know. That's my story, and I'm sticking to it, or that's my cake, and I'm eating it too. Thank you very much for asking. I'd love to know what your opinion is, by the way, Keith. So I think in the next week or two, you're going to be a guest. What do you think? Can you do that? Can you make some time for me, buddy? I'd really appreciate it. All right. I'm going to end this broadcast now. Thank you so much for watching. I really appreciate it. There's so much going on, and I hope I helped make some sense out of this. We really didn't get into the Fed stuff, but I think you've seen so much about it over the weekend that it's kind of like talking about that is like beating the dead horse with a stick at this point. Nothing against dead horses. All right. I'll see you. I won't be here tomorrow. I'll be back Wednesday. For those of you who've been following our story, my wife just had her last chemotherapy last week. We're seeing the oncology surgeon tomorrow, and she did very well with the surgery and the chemo, and got a really solid reaction, great reaction from the chemo. So we're very optimistic, and we're just going to go for the update, make sure everything's okay, and find out what the next course of action is. And we are so looking forward to moving on with our lives. Yes. And hey, Keith, how are you? Savor the flavor of the awesomeness in you, sir, for sharing this with us. Keith, I love your enthusiastic comments on social media. I have to tell you, you were Mr. Enthusiasm. Thank you very much. I really appreciate you. And now I'm going to end the broadcast. Speak to you soon. Oh, wait. Jack is there. Good luck. Thank you, Jack. Shout out to Jack. Thank you very much, Jack. I really appreciate you being in on the call. Oh, man. I hope you were enjoying a good stogie on this beautiful day. Maybe a drink, some ice marinating. All right. Talk to you soon. Bye, guys.